elevated levels of close to 10,200 because earnings have not picked up materially. But do valuations worry you for now?
So it's not a question of comfort or discomfort. I mean, this is where the market is as things stand right now. Yes, we have a situation where earnings have kind of not picked up, and if you look at the valuations right now at the index level, you're probably trading at 18, 19 times forward 12 months earnings, so which is obviously definitely elevated. We are probably one standard deviation above the long period average. Having said that, I would think that we would continue to trade at these kind of valuations as long as the domestic liquidity continues to be fairly strong, which seems to be the case as things stand right now, because the alternate asset classes seem not to be performing up to the expectations of investors. So there's a lot of money flowing into equities as things stand right now. While there's been some amount of FI outflows, I think that's the domestic flows of what's keeping the market up. Earnings picture is looking a little murky right now.
All right, we've caught him on a patchy line yet again, but we'll try getting him on the phone line with us and try getting a sense of what pockets or sectors of trade look good. And speaking about that, let's pull up the pharmaceutical index, because while it has been in some kind of consolidation mode in yesterday's session, but in the last week, you saw the pharmaceuticals doing well as a pocket in its entirety. Even in today's session, there are no major moves, so it's only down 0.3%. But if we can pull up a longer term chart, it'll be the last week's gains will be reflective, especially on counters like Sun Pharmaceuticals, which behaved themselves and saw moderate gains in the last week. So there was that short spurt in the last week, and after that you've seen some kind of cooling off that is coming through ever since this week has started. 13.5% high on a 1 month basis is what Sun Pharmaceuticals has returned. But Mr. Pai, you were speaking about valuations and how do you see earnings recovery panning out? So please continue, sir.
Yeah, so I think earnings have not been up to expectations. I think when we started the year, we were looking at something close to, at the case the consensus was looking at something close to high teens kind of a number. So post first quarter, I think the consensus numbers have probably come off to mid-teen kind of a level. And I expect that as quarters pass by, we'll probably see that number closer to very low double digit or probably even high single digit come through. So it's going to be yet another year of earnings disappointment. But I think somewhere down the road, we should see the earnings turn up to a significantly higher number, because this is probably the 8th or the 9th year when we've seen this kind of earnings growth come through. If you look at the earnings growth pictures in the FY08, when we had a very high earnings to GDP ratio, it's been a downhill since then, and we've seen just about a mid-single digit kind of earnings CAGR for the index. So somewhere down the road, we think that the earnings growth should pick up to high teens or early 20s for a 2 to 3 year time frame. It could be FY19 and going into FY20. I think that could be the year where we could see that happen. See, the thing is that right now it's only consumption which is driving earnings. There is the investment bit, there is the export bit, and commodities part which have to contribute. The commodities have kind of come to the party, but I think the other two, investments and exports, have not really contributed very much. So once all the four engines fire, I would probably think that we will have a fairly strong earnings growth picture. But that is somewhere down the road is the way I see things.
So, Mr. Pai, apart from consumption, are there any other pockets that you're focusing on? And from this level onwards, what are certain stocks or certain areas that you look positively?
Right. So on the we're positive on few areas. One is definitely private financials. Valuations there have run up pretty substantially as things stand right now. But having said that, I would think that an area, pocket of private financials which look interesting are still fairly cheap are the gold financiers. Yes, the growth there isn't as great as what one would come across in consumer finance, where the growth is probably 30-40% CAGR. Here you have growth of 10 to 15%. But having said that, you have excellent collateral. We have I would think a slightly safer business as things stand right now, but the ROA is 3.5 to 4%, And the valuation multiple is also fairly interesting to look at. It's just about 2.5 times FY19 adjusted book compared to, very high multiples you see on the NBFC space. So I think that's a pocket to look at. I still think there's a lot of value there. We're talking about Muthoot Finance and Manappuram. The other area we kind of like is the pharmaceutical space, where we're covering certain large caps like Cipla, Dr. Reddy, Aurobindo, and certain smaller stocks. Like Indoco, for instance. So there, our call is that the sector has seen a fairly sharp derating and fairly sharp earnings cut over the last, I think, 12 to 18 months. And we think that we're probably at the bottom of the cycle. Maybe if not now, maybe over the next 12 months, we'll probably see the bottom of the earnings cycle. And things should turn up is the way we look at the pharmaceutical sector. And we think that this is probably the time to get into the sector and hold on for a 2 to 3 year time frame. And so we think it's going to be, the returns are going to be more back-ended. We could probably see a little bit more volatility in the sector. There could be news flow, which is probably not going to be conducive for, a steady stock price performance. There's going to be volatility there. But having said that, we think the opportunity is there for the Indian companies to address. There are tons of areas to look at within the US pharmaceutical space. Our analysts, the kind of drugs that Indian companies are currently working on have far more competition, and that's why we actually keep hearing about price competition. Whereas he believes that there are about 50% of the drugs and generic drugs in the US where the number of players are just about 3, and where we do not have as things. And there are other parts of the market which are non-oral solids related markets where we think the price competition isn't as much as there in that area, where we don't have as much of a share. So I think these are areas to look at. Plus, there is a $200 billion expiry of patents that's going to happen in the next 5 years or so. That's an opportunity to look at. So I would probably think that the pharma opportunity continues to be fairly robust for us. Yes, we're going through a bit of a troubled time because of compliance-related issues and also because of pricing pressure in the oral solids business. But we think we overcome that. We think the compliance is a transitory phase. So we're kind of positive on these stocks that I talked about: Dr. Reddy, Cipla, Aurobindo Pharma. So those are the kind of 2 areas that I would want to kind of focus on. The financial space, where we think gold finance is an area where we'll probably see slower growth, but better. The visibility is there. The valuations are slightly more cheaper, more comfortable, and pharma is a and more a long-term bet. But we think that the risk is very much better in favor of investing right now.
Fair point, Mr. Pai. That was a rather exhaustive answer and a detailed view in terms of what sectors are you looking at preferably, and also in terms of a detailed stock-specific viewpoint right from here on, from these levels. So thank you so much for joining in and taking us through that list of stocks that you feel are likely to do well from here on, and also the pockets of or sectors that you prefer in this market. But that's all the time that we have on this edition of Trending Today. Thank you so much for watching.